Welcome to the Finance Podcast. The topic of this episode, Marketplace Lending, Opening the Door to Previously Unreachable Asset Classes by Andrea Canonica, Alwin Meyer, Fabio-Guido Perlini and Stefan Pomberger, moderated by Nadine Berchtold.
Great, very welcome. I'm very happy to see so many faces that are interested in marketplace lending, and I have the pleasure to introduce the topic to all of you. Some of you might be familiar with it already, and the others are hopefully or will be familiar with the topic after this presentation. So my name is Nadine Berchtold. I'm a senior research associate at the Hochschule Luzern at the Institute of Financial Services. There we study, among other topics, marketplace lending, the development in Switzerland particularly, and we are actually quite proud that we have one of the most transparent markets in Switzerland, because we are the only ones of the different countries, the different markets that get the data, even down to the risk and return data of different platforms. And this, of course, is one of the points that I'm going to present to you today. Also, this is the second part that is written here. I'm the General Secretary of the Swiss Marketplace Lending Association, SMLA, and in this position, I am in touch with all the platforms active in Switzerland in the field of marketplace lending. Now this is what I'm looking for. Great. So marketplace lending, opening the door to previously unreachable asset classes. This is what we're going to cover today, and we're going to learn how exactly this is going to work, what kind of asset classes, and how you as investors can access them. So first, what is marketplace lending? It is the process of arranging debt capital between lenders and borrowers online via a credit marketplace. So it is part of private debt. It is a subgroup of private debt. It is also part of digital lending, and it kind of combines the two worlds. And then there is marketplace lending. And the debt, what is debt, what is credit? There is actually no difference to what you know from the conventional world. The difference here is that you can do it directly. So these platforms, they directly connect the lenders and the borrowers. This is the process overall, how it looks like. Who is involved? So we already covered there is a borrower, there is a lender, they are connected. And in between, yes, there is a marketplace lending platform. They are structured a bit differently. They also have different kind of fees and fee structure, how they charge, who they charge, the platforms, the lenders, and how much they charge. But it all ends up in a circle like this. And this opens up the possibility to directly invest in loans and other debt products that were previously reserved mostly for banks. And this is why, through marketplace lending, there is a unique way of getting access to the risk premia that really was associated to traditional banks. This is what the whole beauty is about marketplace lending. Within marketplace lending, we have different segments, so it's not all the same. Here we have on the left-hand side, we have different kind of lenders, and we have also different kind of borrowers. So they are, with marketplace lending, you do connect them. And depending on the sub-segment of marketplace lending, you have different kind of lenders and borrowers that are connected. One part is so-called crowd lending. So this was the initial name. We started from crowd lending because many different private investors as well could access these kind of loans. To crowd lending, there is part of consumer loans, but it's also real estate loans, and it's also business loans. But you do see, if you look carefully and if you can read it, otherwise I'm going to help you, it is no longer only for private investors. More and more we see institutional investors also taking place in in crowd lending, and sometimes we really have the discussion if crowd lending is still the correct name to call it. This is also why we move a bit away from calling it this way, because it's less and less the crowd, and it's more of really a small part of institutional investors that are accessing these classes as well. And then on top, we have other kind of marketplace lending segments. These segments that I have listed on top, these are segments that are only accessible for institutional investors. So there no access for private investors. We have mortgage loans or mortgage brokerage loans that are part of this segment. We have institutional loans or government, municipalities loans. Then one is loans to mid-sized and large corporations, public bonds, and there is also the money market segment there. So overall, we identify 8 different segments that belong to marketplace lending, and they are different by who are the lenders and who are the borrowers. In Switzerland, currently, we count 31 different platforms that are actively offering these kind of services. The most established or the most platforms that we observed are active in crowd lending and mortgage brokerage. And in the other segments, there are a few platforms as well, and we will also hear one representative of the ones that are not that many platforms yet. What is also interesting is that we have currently 31 different platforms, especially in the crowd lending segment. There we have also observed a market consolidation over the last couple of years. So this really means, well, it's still a new asset class compared to other asset classes, obviously, but within the recent years, through this market consolidation, now really the platforms that are that will stay, they are still here, and the ones that are maybe not as profitable, they have already moved out of the market. Yeah, so these are the different segments, and on the right-hand side, it's just a list again of what kind of assets now you can gain access that sometimes previously were not as easy to access. So we have the mortgage market, consumer loans, corporate loans, SME loans, money market segment, and also, well, now I switched them. This should be government and municipalities. Have to be a bit creative when looking at them. But these are the asset classes that you can gain access to that were previously really difficult to access. So now the question is, I told already that we're moving a bit away from private investors and really are focusing more on institutional investors. This is why I want to have a closer look at who exactly is investing in marketplace lending. These are the figures from 2021 until mid-2023. These are the newest figures that we have. And we see that roughly 50% of the institutional investors, they are pension funds or asset managers that already use the possibility of investing in marketplace lending and crowd lending. And of course, as I said, in crowd lending, there are also private investors. Currently, it's roughly 40% private investors and 60% institutional investors that use the crowd lending market.
Why is there such volatility between the years with the different groups?
Is it a big volatility?
Yeah, I would say like the pension funds have significant.
Yeah, we will see in a bit. We will have a look at the volumes of the market, and then this obviously then also explains a bit why you still see the changes there. But there is some volatility, but I also think this part is quite stable. So we're moving between, let's say, 48% to 58% of pension funds and external and asset managers. Yeah, speaking about volumes, these are the volumes of mortgage brokerage platforms. And you do see that the volume has increased from 2017 to 2023. The new figures will come out in June, so we need to wait a bit. It has significantly increased. We will hear later a bit more from two mortgage brokerage platforms that we have with us today. And of course, also there we see that there is an increase, but of course it's also possible that, like we saw last year or 2 years ago, that sometimes the volume is not only going up, because it has gone up over the last couple of years quite a lot, and we will see also with the changing interest environment that now we are quite positive again, and maybe you can already give us then a sneak peek into how the market looked like in 2024 and how it's looking currently. We will see that.
Is that net new volume or total volume?
This is net new volume. Yeah, this is net new volume. All the volumes that I'm showing you, they're net new volumes, exactly. And this is, of course, you see when you look at the volume, it's still a niche. And it's the market share is estimated about 3.5% of the whole new mortgage market. So there is still potential to increase that volume. And we expect that this market is still growing, although probably not at the rate that we were seeing from 2017 to 2022. Here we see the volume for public entities, mid-sized and large corporations. So basically in Switzerland, these are the volumes from Cosmo Funding, because this is the platform active in this business, or mostly active in this business. And we also see some parts, though the majority of the volume comes from loans, but we also see a very small proportion of listed bonds. So who exactly is financed there? These are very particularly Swiss cantons, for example, or different cities. And actually I was participating in some of the other speeches today, some of the other panels, and it was very interesting to hear that also they consider now with this uncertainties in other countries as well, they see that government bonds might not be as safe as they used to be, and this of course also makes this asset class very interesting again when we look at at the market in Switzerland, which is still quite reliable. We know what we expect. The government is quite consistent. We don't have this political or this extreme political shifts every couple of years. So this definitely also makes this asset class very interesting in the future, especially in times of uncertainty like right now, or political uncertainty like right now. Here I don't have a chart, but I have a number, which is quite large. So we're talking about $390 billion in volume from the money market transactions in 2023. So this number is much bigger than what you saw before with the other segments, but there is a very easy reason why this is the case. So money market, in the money market, the durations, they're very, very short, right? And because correctly, these are newly issued volumes, so obviously it adds up quite quickly, and we get a very high number there. And it's not really comparable to the other segments that I'm going to show you volume-wise. But also there, it's currently InstiMatch Global that is active in this segment, opening up a very quick and easy way for the money market to provide liquidity to the market. And all of this, so sometimes they're really just a couple of days, but the majorities are almost always less than 1 year in this money market segment. And then before I'm talking about risk and return, so this is the last slide that I have about the volumes. This is a summary of the crowd lending market. Also here you see it started in 2012 and it has increased very rapidly. We have consumer loans, business loans, real estate loans. What you see depending on the business, of course, here in 2019, 2020, the SME volumes, they decreased. Why? Because the government was providing money for free to the SMEs. So of course, for the business, it wasn't a very good year for this regard. But since then, it has increased again. And also, why do we expect this segment to further grow? Because we do see that some banks, they are a bit more restrictive in handing out loans to SMEs. And this is why then it's going to be very interesting to look for other opportunities outside of banks. Also, a study that we conducted for the SECO in 2021, we analyzed how many SMEs are actually getting a loan once they go to the bank. And we saw that 10% of all SMEs, they would be in need of liquidity, they would be in need of a loan, but for some reason, they are not going to the bank and asking for a loan. Although, for all the SMEs that go to a loan, 97% of these SMEs, they get their loans approved. So you see there is a big share of the SMEs that are for some reason afraid or they don't want to go to a bank to ask for a loan, but it's not, from these figures we can assume it's not for creditworthiness that they don't get the loan, because 97% of the ones that go, they do get a loan. There must be some other reasons, right? And this also means there is still a big potential for this market to further grow once these SMEs they are reached. But this is, I think, one of the bigger challenge. But Alwin from Swiss Bears will maybe tell us a bit more about that later. This is one of the biggest challenge. How do you get to these SMEs? How do they know about marketplace lending, that this exists, and that there are other opportunities, other possibilities to get money apart from banks? So now we're talking risk and return. These are the vintage loans from the crowd lending vintage loans. So now we're talking about a very particular segment of marketplace lending. You still hear it? Should I open and close it? You're fine. Exactly. And what you can see, you observe that it's kind of a U-curve. So the returns, they start quite high because there are no defaults at the beginning, hopefully not after 1 week. And then you see them decreasing. Why is that so? In the report and from the platforms, we have quite a strict procedure, a quite strict calculation. So every loan that has not paid the interest rates for more than 90 days, they are counted as complete default. So this is why then the figures go down at the beginning, and this is also why then usually they increase again, because at one point they reassume their payments, and then of course also the interest rates, they go up again. What you also see from this figure this is still an asset class you need to diversify. So it's not, I don't have a magic package where you don't need to diversify, but also within marketplace lending or crowd lending, you need to diversify, because obviously depending on the loan vintage, depending on the economic situation as well, they might turn out a bit differently, the different loan vintages. Overall, if you are diversified within different segments maybe as well, but also within different loan vintages, you can, historically speaking, you can expect a return, net return. So this is after fees and everything. You can expect a return of 3 to 3.5%. And as I said, so this is net after all the fees, and also after all the defaults that might occur within this time. Right, so what I have told you now is all written down in the marketplace lending report that I have written with my colleagues, and I have also briefly mentioned it. In June 2025, we are publishing the new figures, the 2024 figures, and then we will present these figures in September during the conference of the Swiss Marketplace Lending Association. Yeah, because sometimes, well, I'm from academia, and very often I hear I am too far away from the practical world, and I don't know, or we don't know in general, academia doesn't know what's really happening in the market. And because I don't want you to leave with this feeling, we have 4 people that are active in marketplace lending. They are active in their different segments for their platforms, and they will give you some first-hand insight about how marketplace lending actually might look like. Yeah, so we have Fabio Perlini from UBS Key for Mortgages. We have Alwin Meyer from Swiss Peers, crowd lending, SME crowd lending platform. We have Andrea Canonica from Credit Exchange, mortgage brokerage platform, same as Key for Mortgages. And we have Stefan Pomberger from Cosmo Funding, Fundhubble. They are active in the field of municipality financing and also mid to large corporations. So welcome to the stage. You have to share the microphone on this side and on this side. Oh. Great. So I have prepared some questions for gentlemen, and then at the end, I'm very happy to take some questions from you as well. So you can also ask either me or the gentlemen directly. Yeah. So I'm starting with you, Stefan. You are also board member of the Swiss Marketplace Lending Association. So in your experience over, I think it's on already. In your experience, what do you see as the key value drivers of marketplace lending?
Great. So thanks, Nadine. Thanks all. Welcome everyone for having me today. So currently we see quite many developments, but I think the most important ones is the one of the Credit Suisse and UBS event that we had obviously in the market. So with Credit Suisse being gone, there is some financing gap to be filled. We see Basel III as an event for the banks in particular when it comes to financing, especially when there is the demand for financing on the issuer side, and especially issuers that had no home bank or house bank before, because a bank always likes to pair it with assets. So if you have assets, it's easier to get to financing. So speaking about Lombard lending or these kind of parts, and obviously when there have been issuers always aiming for the maximum, meaning having to pay the least, this has led to the fact that some of these issues are not interesting anymore to be financed by traditional banks. So currently, what we are seeing is a huge effect in private debt, in lending, in different kinds of forms, and this is what we see. And we see a lot of. We talked about loans before. In the wider sense, we are securitizing most of our products. So totally, we transacted, as you have seen from Nadine's chart, more than 50 billion of Swiss francs of money, and most of it was in private placements. Most of the fraction, and part of it currently also in public bonds. So this year, starting of the year, we did 20 public bonds as well in different domains. I can say later a few words, but this is the high-level effect that we currently see, and most accelerated it's on the mortgage side at the moment, and for SMEs. But SMEs, we are not active yet.
Not you, exactly, yeah. We get to that later with Alwin as a representative. Yeah.
And maybe as a last point, we have always done business with institutional side, so we have a business-to-business model and a business-to-business for consumer model. So this is the points where we are active. We don't have a B2C strategy.
Great, thank you. I also would like to be a bit more critical because obviously they're all advertising their platforms, right? So maybe also covering the risk on this side. Fabio, what do you think? Now we talked about value drivers. What do you see as main risks in the field of marketplace lending that should be considered?
So when we speak with investors, and mostly institutional investors on our end, it's basically two main topics on the risk side that we discussed. On one hand, it's the concrete risk of the underlying. So in the case of mortgages, what is an expected loss of a mortgage? What is a loss given default of a specific mortgage? So the specific risk of the underlying. And probably it is a bit special in the marketplace lending that the availability of data is a bit trickier than with other asset classes. And that's a big focus also for us to kind of educate investors on that. And the second obvious risk, so to say, is the illiquidity of the asset class. But I would say when I speak with investors, for a lot of them, the illiquidity is also a potential. A lot of investors also have very illiquid liabilities, so they kind of appreciate also the long duration and the illiquidity of these assets, and they're happy to earn this extra yield that comes with the illiquidity. So it is a risk, yes, but it can also be an opportunity for the correct type of investors. Yeah.
Mm-hmm, mm-hmm. Yeah, you mentioning the diversification as well, and that this is important. So maybe handing over to you. I also mentioned that it is important in general to diversify. How do you see the correlation of marketplace lending or mortgages in your field compared to let's say the equity market?
Well, actually, mortgages are a great tool to diversify your investment portfolio because they do not correlate with other markets. It is very important to directly invest into mortgages because by doing so, you can book the position at nominal value. And so it doesn't matter what happened to the stock market or to the bond market, you always have your investment at 100%. So at the end of the year, you get your 1.5, 2% return with 0% volatility. Then you mentioned marketplaces. Actually, marketplaces are a great way to diversify within the asset class. Why is it so? Well, because in Switzerland, the majority of the financial institutions have a regional footprint. Well, one big exception standing next to me, but for all the others, if a regional bank wants to grow its mortgage portfolio, without marketplaces, they can only finance clients coming into their branches. For a pension fund, it's the same. They can only reach their insured. But it's very hard then to diversify. So at the end, you end up with a relevant risk concentration in terms of client segment, in terms of mortgage sizes, in terms of geographies. With marketplaces, the whole Switzerland gets open up, and you can start diversifying your risk at the end. And by diversifying your risk for the same return, you end up with a better risk-return ratio.
Thank you. Yeah, so you took the mortgage perspective, also put in perspective a bit the marketplace lending. So here we have the mortgage brokerage segment. Here we have on one side SMEs, and there we have municipalities. What do you see? Do you also see there is no correlation to the market in the SME segment, or how do you perceive this?
Yes, definitely. I think we are non or lightly correlated to the other market. So at Swiss peers, you invest exclusively in Swiss SMEs and mainly S of the SMEs. And as we have many of these, you can diversify over the industries. You can diversify by the risk you're taking and by the terms you're subscribing to. And maybe a big difference to my colleagues here is we are really offering that not only to institutional investors but also to private investors as well. On our platform, about 60% is financed by private investors, 40% is institutional money that's on the platform, and they invest side by side. So we call it direct lending, and as a segment of the overall marketplace lending.
Was the graph that I showed with the different kind of institutional investors, is that also true for Swiss peers? So I said pension funds and asset managers. Do you have approximately the same shares?
This 40% institutional money, that is pension funds. So it's one larger fund that has 14, 15 pension funds that are invested into it. That is an investor on the platform. Then you have family offices that are investing typically directly, as you then always don't have to pay another intermediary in between. And you have other type of Stiftungen, etc.
Mm-hmm. Stefan, at Cosmo Funding, who are the investors in Cosmo Funding? You don't need to name specific names, but what type of investors do you have on your platform?
Yeah, I mean, if I look at the composition, clearly I think of asset managers being big currently, followed by pension funds. Then a lot of corporates that sit actually on cash and want to diversify, so not doing a classical term deposit, but actually investing into something you couldn't reach before. So clearly a municipality or a city helps. So also energy-linked company or so something in the semi-public side. But also when I think about it, these corporates, they do finance cantonal banks, so they go with us from or other banks, so they come with the perspective that they say, look, I don't want to open up an account at every place. I want to come to one central hub and you do the financing. And if I look at it, there are some banks in Switzerland where we have financed more than 10 or even 20% of the balance sheet already now, because there was so much demand for deposits. So it was really broad from the manifold of investors. But then it's followed by insurance companies as a sector and certain trusts and family offices. Yes.
You have mentioned, I have noted the figures. So 2024, Cosmo Funding has financed 45.9 billion Swiss francs. Mm-hmm. And for investors, what's the motivation to go to Cosmo Funding to invest rather than just going to the public market and do their investments there?
That's a good one, because we do public bonds as well. So just last week was very crowded with public bonds. We for example, had from a cantonal bank to Canton of Ticino to City of Winterthur to ourselves. So we did our first inaugural bond as Bank Vontobel. We also did it over the platform, 200 million, 5 years at the spread of 80. You could do it there in the public market, but I think it comes down to your comment, Andrea. It's to the part of if you don't need the money next Wednesday, but if you have some time to hold it, in the sense of a liquidity premium, you're getting compensated for that, for buying, for example, a private placement. So that's a big argument. So you get an illiquidity premium on top of your normal spread. There's also a paper out from the data last September, which was published together with you on the HSLU. So whoever is interested, there's a study about it. Now the spread's even widened. So whoever reads the study, it's already old. And there will be a new one in summer, because credit spreads were widening like I mean, I'm now with Fontobel for 15 years, but it has never been, to my experience in that regard, that wide, because we have seen cantonal banks that currently need to refinance themselves at the level of 60 basis points. And if you're a cantonal bank not state guaranteed, you're at 70. And think about it. I mean, if you get your refinancing on that side on the liability side, and you already have to pay yourself 60 or 70 basis points, the mortgage will be 100 or even more, in your classical asset side terms of business. So there is already the spread widened, and this has led to a parallel shift, actually, of the return. So this was helpful for private placements. That's the one aspect. And the second one is, in a private placement, having an ISIN, you can easily book it in your account. It counts also as asset under management. This is all helpful for family offices. What we do is we profit from the aggregating effect. So when we can pool the money, so there is someone who wants to put in 1 million or 500,000, and you pool it, and you come with pricing power of 10 million, you just have transformation of capital. You have more power if you come to the table with 10 million or 20 million, so you get better prices at the other place. So we do profit also from that effect. So I think these are the two effects that come here together. Why people are using it that heavily. I mean, as you said, last December it was 45 point something, 46 billion that we did, and we see growth momentum. And there are some sectors currently that are concerning, where we even have to close the door currently to issues, because we have so many requests at the moment, and it's rather than always the balance finding not only the requests but also the investors, because we do observe the Credit Suisse event and the Basel III, and what I said in the beginning, some cantonal banks only being active in the home canton for different reasons. We do observe that.
Yeah, matching, you mentioned something, matching demands in supply, so
exactly.
Kind of lenders and borrowers. This is a specifically tricky challenge in marketplace planning overall.
It is, and the access argument from Andrea is important, because what you certainly don't want to do, and I can say this after 8 years of being active, after the foundation, in these 8 years it's so tough to get the first billion, and then you work yourself up, and even then, the point is, it requires so much distribution effort to get to the names. All of you are nodding, so you know what I mean. So for the clients, it is a plus to get this access via marketplace lending. And I think having people out there making it possible to invest. In Switzerland, we are somehow behind the curve, because if you look at it, when we did, for example, an 81 with Apollo Global Management, and when you look at Americas or Europe, the sector private debt, it's so massively growing, and here it's still behind the curve in terms of volume in that sector. But this sector, private market, private debt, it's very attractive, in my opinion. Yeah.
I agree. Yeah.
Sorry for taking.
Let's move back to the mortgage market. So I think I already heard kind of a discussion over there before this presentation. I'd be very interested what kind of buildings are financed with mortgages there. Single family homes, or what do I have to imagine there? Maybe Andrea.
Yeah. So at the very beginning, over our platform, we were only able to match single-family houses just for replacement of mortgages. It was a very little fraction of the market, and over the time we expanded. Now we can offer from self-used properties to holiday homes, buy-to-let, up to income-producing real estate. The journey took a bit for us, because we strongly believe in the automated credit decision. So everything we implement on our platform needs to be tradable instantly without manual checks and so on. So we took our time. And now within the private mortgage market, we can cover, I would say, 70%. We still have our limitations left and right, but more or less 70% we can cover.
Is it the same, for Key4 mortgages?
It's comparable. I think there are some differences, especially with regards to income-producing real estate, which was kind of where we came from originally. So I think there we are probably a bigger part of business in there.
maybe a question regarding the interest rate environment. So thinking about mortgages, in what kind of interest rate environment it's particularly interesting? So I'm thinking about right now, again, decreasing interest rates. Does that make the mortgage market particularly interesting?
Yeah, I think it's a very good point. I think it was a big push for the asset class when negative interest rates occurred for the first time, and we saw quite a lot of inflow and interest from institutional investors that, were looking for an alternative to traditional high-grade fixed income. And I think what we saw then is that even when interest rates went positive, a lot of investors stayed in the asset class because the relative pickup versus comparable bonds, was quite stable. And they appreciate that relative pickup, but you probably have now, with lower interest rates, again, yet another reason to invest in mortgages because of that effect that other high-grade fixed income is close to zero, and at least you have something positive yielding. So I would say it's not only mortgages, it's in general everything with a little bit of an illiquidity premium, marketplace lending, etc., that probably profits from lower interest rates because investors are just turning to the asset classes that still offer some more yield. But I think it's important to understand that also in positive interest rate environment, the relative pickup was always there. And I think, we saw it in the figures. Investors were not turning their back on the asset class, but stayed invested.
Thank you. I think we're almost running out of time. I have one more question to you, Alwin, because something is, especially at the beginning, was haunting the crowd lending segment, and it was the rumor or the view that crowd lending platforms, they only finance SMEs that do not get a loan from a bank, and then they go to the crowd lending platforms, so they're only bad borrowers. Is that true?
So that's a myth that is still persistent in the market. When you look at our portfolio, so we have transacted about 800 transactions via our platform. I would say about 60% would also get money with the bank. Why they come still to us? Because we are offering smaller size tickets and we offer that fast. And the other 40%, I wouldn't call them bad, but they just represent a higher risk than a bank balance sheet can absorb. And a higher risk also means a higher interest. So that's loans for investors that know what risk return means. And if you're investing into these loans and do that in a diversified way, then you can earn very nice returns on that side. So again, 60% would be capable to be financed by a highly leveraged balance sheet of a bank, and the other 40%, they are beyond, let's say, the banking regulation that's around there.
Interesting. Thank you that you helped us with that myth.
So I hope we busted it.
Any questions from the audience? Yes, you will get a microphone because it's recorded, and I will hand this one to you.
Thank you so far. What's the typical ticket size and what's the maximum typical size on these platforms, please?
Very different on every platform, yeah.
Very different on our, let's say, the self-occupied real estate. It's everything from 100,000 to 2 million. And on the income-producing real estate side, it can go up above 50 million. So it can be also very large tickets that we process.
Well, exactly the same for us. But because you also asked about average, when we look at the private mortgages, in Switzerland, we are really around 400,000 Swiss francs for every mortgage.
So in the SME market, we are at an average of about 250,000 Swiss francs. Smallest tickets we do is 50K. Largest tickets with a broad audience of investors goes up to 1 million, and beyond 1 million, then from a regulatory point of view, it's just for institutional or a little group of investors.
So for a single ticket from 300,000 smallest up to 300 million, one shot, 2 weeks, up to 50 years.
Thank you.
Yes, there's the microphone.
Is there any pooled solutions in Switzerland?
Me, you. Well, it depends a bit on. Oh, I already have a microphone. It depends a bit on the market. So, especially in the crowd lending markets, there are funds as well that are offering, that are pooling the different investments, and so you get directly a diversified portfolio. I don't know if you also on your platform offer kind of pooling, Alwin?
Yeah, so there are some funds that are investing that you find out there where you can invest for our asset class.
Yeah, absolutely. So starting with money market funds on the one hand side, but even going beyond classical asset management in the private debt area. But there could be more, actually. And could be more.
Maybe if I can be...
Please.
Just to build on this, yes, there are funds which invest on mortgages, but as long as your target portfolio would be, or it's expected to be, I would say, above 10, 20 million, then it's way better to directly invest in mortgages because then you can book at nominal value. If you buy the fund, then it's traded at market value and then you get the volatility.
Yeah, as mentioned, I mean, on the mortgage market, it's funds that are exclusively accessible for Swiss pension funds. That's the biggest. It's called Anlagestiftung in German, and that's a specific type of pooled vehicle exclusively accessible for pension funds. And they are quite big in Switzerland, investing in mortgages only. With the pros and cons, you have a mark-to-market of these funds as you can enter and exit. Exactly.
If you had a free wish, something which could help to boost your business, what would be your wish? Maybe each of you guys.
Fabio, you want to start?
I have least time. I think the biggest challenge I have when I speak with investors is a bit the availability of risk figures. So, the return is super easy to understand. What do you earn with an investment? But the risk figures are probably a bit trickier to understand because, as we saw in the past, it was mostly financed by banks, and the loss figures are not publicly available, or only until recently. And I think having more transparency also on loss figures of the underlying asset class, I think that would help and would probably boost and demyth some assumptions. I think that's one wish. You ask for three? Wow. Okay, yeah, otherwise it takes too long.
Well, when you look at the mortgage business, the market has been very static over the last century. So my wish would be to speed up a little bit on the development, to embrace technology, embrace marketplace lending, to let this business grow slightly faster.
I couldn't agree more with you, Andrea. I think that's when you looked at the numbers that Nadine has shown, right? We had a very steep start. Afterwards, we had some challenges in the market, in the SME space. As Nadine also mentioned, it was Corona that has, with the free money of the Swiss government, that has put a little bit the brakes on. And I think now we are back growing again. And it's really getting that asset class and known on both sides, right? On the SME side, being not too shy to try it out, and on the investor side to really see the value of this investment into these type of asset classes in terms of diversification and getting in the Swiss fixed income market a nice return.
I said before that asset managers are already quite important. Just by observing the different segments, I think there is still a lot of leeway and room for another asset manager to jump onto this topic, especially in terms of private markets. So some entrepreneurial group or more entrepreneurs jumping on and also profiting from the success that asset managers are already having with investing into this group. I think this is where the dynamic even accelerates.
If I may add, as the Swiss Marketplace Lending Association, we really try to increase transparency. And of course, from academia, we love data, so we love more transparency also from this side. And one other very important part of the association is increase visibility, increase awareness, because if you don't know what marketplace lending is, how it works, if you have never been in touch with someone in the field, then you're not going to invest. So this is really something that we have been trying to do over the last years and are still trying to do. So transparency and visibility for the whole market, I like to say, yeah. Any other questions for now? Yes? If there's still time, I don't have. Last question, okay.
So how do you do risk assessment of the borrowers on your platforms? Is that an automated way, given that lack of data? What do you do?
Because we are a fixed income ecosystem, we do have a rating agency behind that rates everything. This is FEDAFIN. They are FINMA approved. And certain issues, obviously, they do also have S&P, Moody's, or Fitch ratings. So we always work with the rating agency in between, which is on our ecosystem, FEDAFIN. They also, by the way, now ESG ratings on the platform. So we outsource that because obviously we want to print. And in all honesty, to your wish, of course, doubling or tripling the volumes.
So we have developed our own financial figures-based rating model that is industry dependent. So depending on the industry, the SMEs in that rating model has a little bit different type of shape, and we also offer an SDG rating for this for the SMEs that are actually having an impact on one of the 17 SDGs. Yeah.
We allow every partner of us to fully customize his risk model. Banks, they already have a credit policy, formulas to assess risk, and we allow them simply one-to-one to match what they do internally also on our platform.
I think that's one big difference between our platforms. On our platform, everything is based on UBS credit policies. So investors can be sure stuff that comes on the platform has been credit checked and approved by UBS. That's, yeah.
Great. So thank you very much. The gentleman will still be available for more questions afterwards. Thank you for listening, and we all hope to see you again. Best investing in the platform.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.